The screens are already drowning in red as Scott Bessant steps into the Treasury's secure auction room. No cameras, no speeches, just a room full of traders fixated on a wall of stubborn numbers refusing to budge. The 3-year note sale is on the edge of closing, and foreign bids, the lifeblood of these auctions, are all but vanished. Desperation creeps in as dealers frantically type emergency orders, just to dodge the shame of a failed auction. Outside those quiet walls, another headline crashes in. China's 10-year government bonds now yield a historic low of 1.7%. This is no minor detail. It's a tectonic shift in the global financial landscape. Meanwhile, the US 10-year yield looms at 4.28%, more than twice as high. In a world where the cheapest borrowing costs dominate, this yawning gap is both political and financial dynamite. This divergence isn't a trickle, it's a waterfall. China's entire yield curve, from 2-year to 30-year, is plunging in unison. Beijing taps long-term capital at rock-bottom costs unseen by Western governments for decades. On the other side, the US curve remains stubbornly high, unyielding even to the Federal Reserve's recent rate cuts. Mortgage rates stay stubbornly above 6.5%, tied to the 10-year Treasury, not the Fed's overnight rate. Just 24 hours later, the Treasury's 10-year auction delivers another harsh hit. Foreign indirect bidders, central banks, sovereign funds, participate at their weakest level since 2023. Yields climb mid-auction, signaling that buyers now demand higher returns just to accept the debt. This isn't a fleeting blip. It's a live pattern unfolding before everyone's eyes. By the third day, the 30-year auction sinks even deeper. Foreign demand hits its second lowest point in 5 years. Yields jump across all maturities as traders start viewing the auctions themselves as risky events. In just 3 days, Bessant has witnessed the global market deliver a harsh verdict. The US debt is worth less than the price Washington is asking. China's withdrawal is no accident. Treasury data shows Beijing's US government debt holdings have shrunk to roughly $756 billion, the lowest since March 2009. For months, they've been net sellers, diverting their trade surplus into gold, domestic banks, and loans under the Belt and Road Initiative. The Financial Times reports some of those dollar-denominated loans now carry interest rates even lower than what Washington pays to borrow its own currency. Here comes the first brutal reversal. In parts of Africa and South America, it's now cheaper to borrow US dollars from a Chinese bank than directly from the US Treasury. Bloomberg dubs this an inversion of credit hierarchy, a phrase that would have been inconceivable in serious finance 2 decades ago. Japan, the largest foreign holder of US Treasury, is slowing its purchases as its own yields climb. Middle Eastern sovereign funds are redirecting capital into ports, tech, and domestic infrastructure projects where returns surpass the locked-in yields of long-dated US bonds. Washington's counter-strategy has been surgical. Avoid locking in expensive 30-year debt and instead flood the market with short-term Treasury bills maturing in under a year, keeping near-term interest payments manageable for now. But short-term debt is a double-edged sword. It must be constantly refinanced. Over the coming 4 quarters, $9.2 trillion in existing debt will mature, much of it issued when rates were far lower. Add $1.9 trillion in new borrowing to cover the deficit, and the total refinancing need rockets beyond $10 trillion. With foreign appetite dwindling, this relentless refinancing treadmill is a perilous tightrope walk. Bank of America data reveals foreign custodial holdings at the Fed have dropped by $48 billion since March, and reverse repo positions have shrunk by another $15 billion. This isn't just rebalancing, it's retreat. The second stark irony emerges. The US still markets treasuries as the risk-free benchmark. Yet investors now demand higher returns to hold US debt than to lend to countries with less financial history and far greater political control over their economies. In market terms, Washington is paying a hefty trust premium. The consequences ripple everywhere. Mortgage rates remain stuck despite 3 Fed cuts this year. Auto loans and credit cards grow more expensive. Municipal bonds cost cities more to issue. The Fed's overnight rate cuts ease bank-to-bank lending, but fail to dent the 10-year Treasury yield anchoring long-term borrowing. Without strong foreign demand soaking up supply, yields remain stubbornly elevated, tightening the screws on the entire economy. The cracks aren't small. They're deepening fissures in a global financial order once taken for granted. The dance between politics, trust, and finance is reshaping the cost and meaning of US debt in ways unseen for generations. Corporate America is feeling the drag hard. Refinitiv data reveals that US investment-grade bond yields are nearly double those of comparable Chinese state-linked issuers, undercutting US companies' ability to invest at competitive costs, and gradually shifting the global expansion landscape. Forget the jargon and spreads. Ask instead how the nation that built the global financial highway ends up paying tolls just to use it. Auctions aren't mere sales, they're trust votes. and this summer delivered too many no votes. This erosion of trust goes beyond deficits. It's rooted in political dysfunction. The August auctions took place amid another bitter budget standoff. Foreign investors don't need the fine print. They price in the whole spectrum. Meanwhile, China's inflation is flat or negative, its trade surplus widens, and the People's Bank of China still has room to cut rates. Adjusted for inflation, Chinese bonds yield more than US bonds. Currency stability boosts their appeal. The yuan has held steady through 2025, backed by export surpluses and strict capital controls that curb volatility. For foreign holders, this means less currency risk, making low nominal yields acceptable. Meanwhile, the dollar has weakened against a basket of major currencies since early summer, eroding the real returns on US Treasuries for overseas buyers. The US market structure exacerbates the problem. Treasuries rely on a complex ecosystem. Primary dealers, foreign central banks, asset managers, hedge funds. When any one group pulls back, others demand higher yields to compensate, creating a self-reinforcing cycle. The more it costs to sell debt now, the pricier the next issuance becomes. China's capital strategy highlights the long-term issue. Instead of recycling export dollars back into treasuries, Beijing channels funds into overseas infrastructure, commodity deals, and equity stakes. These investments often use dollars but bypass US debt entirely. This disrupts the automatic recycling of trade surpluses into American bonds, a structural shift in global capital flows. China's Belt and Road loans showcase the power of cheap credit, averaging around 4.2% interest, roughly 2% less than US borrowing costs. These loans undercut Washington's rates. This advantage lets China expand influence through ports, railroads, and energy projects without firing a shot. Meanwhile, the US spends more just servicing existing debt. By year's end, interest on US debt is set to surpass defense spending for the first time in modern history. While this doesn't pose a default risk, it severely limits the government's flexibility in any crisis. The Federal Reserve can't simply fix foreign demand with overnight rate cuts. Boosting appetite would require higher real yields, worsening the interest burden, or credible policy shifts proving long-term fiscal sustainability. Global capital is already hedging for a future less anchored in treasuries. Asian and Middle Eastern central banks are building local currency bond markets, reducing dollar dependency. The IMF reports the dollar's share of global reserves has fallen below 59%, the lowest in decades, a monumental shift. The foreign retreat from US debt shows not only in auction results but also in derivatives markets. Treasury futures exhibit unusually wide bid-ask spreads during auctions, signaling thinner liquidity. Bloomberg reports primary dealers hold more unsold inventory post-auction than any time since 2016, forcing discounts to clear balance sheets, effectively a liquidity squeeze. Meanwhile, China's record-low borrowing costs are bolstered by surging domestic bond demand. Reuters notes state-owned banks have been directed to absorb more sovereign debt, locking yields that outpace deposit rates. This feedback loop keeps demand stable, pushes yields lower, and reassures global buyers seeking safety amid US rate volatility. The World Bank's recent cross-border flow data confirms a dramatic pivot. In H1 2025, emerging markets excluding China saw net inflows of $84 billion. But China alone attracted over $120 billion, a reversal from post-COVID years when capital fled emerging Asia. Meanwhile, the US faced a net outflow of nearly $35 billion in long-term securities during the same period. The auction drama is just the tip of the iceberg. The tide is turning, and it's not flowing back toward Washington. August's auctions are a signal. Treasuries remain core assets, but their privileged status is fading. If foreign buyers keep demanding higher yields, the so-called risk-free rate will climb, driving up capital costs for every borrower tied to it. In the Treasury auction room, Besant stays at the table, screens flickering with the next batch of bids, smaller, thinner, costlier. He knows the numbers dwarf him, even the administration, yet the change feels personal. The man once dubbed the nation's top bond salesman watches buyers walk away. This is the new reality. It's not just about auctions or spreads. The US, which built this market, now sees others borrow cheaper, faster, and with less scrutiny. Beijing's 1.7% yield isn't just a number. It's a statement. The center of gravity in global finance can move, and just has. We're glad you're watching. Please like and